Hey everyone, Koch Investor back to another video for today. So let's talk about Verizon, the big telecom company. Most of you that hold this company hold it because of the nice dividend yield that it provides, not because of the growth potential. Actually, if you look at the stock in the last 5 to 10 years, it hasn't really been that great for investors, but you do have a nice dividend payout. Now, the last time we talked about Verizon, we also talked about AT&T. By the way, AT&T just reported earnings as well, better than expected. That will probably be the next video. Now, Verizon also better than expected earnings. They gave us more information with regards to how safe the dividend is. Are they going to do any buyback soon since cash flows are increasing? And what about this whole Wall Street Journal story that we talked about last week with the LED cables? How much is it going to cost the company? Is it going to cost the company? We're going through that in this video. I'll actually start with that and the comments that were made during the earnings call. So they said here, we take these matters seriously. And to be clear, LED infrastructure makes up a small percentage of our copper network, and we began phasing away from installing new LED cable by the 1950s. At Verizon, the communities we serve and our employees are at the heart of everything we do, and we're using a fact and science-based approach in our assessment. Tony then said, we still have some legacy LED sheet cable in our copper network. As a result of the age of this infrastructure and the history of the industry, records are incomplete as to exactly how much of the cable at our network has LED sheeting. However, to give you a sense of the scale of the infrastructure we are talking about, our copper network is comprised of less than 540,000 miles of cable, roughly half of which is aerial, and LED sheet cable makes up a small percentage of our copper network. When not distributed, the likelihood of exposure to LED from LED sheet cables is low. In addition, because the LED sheet cable was used as a feeder and distribution cable and does not run into individual homes or apartments, it is generally in locations that minimize the potential of public contact. We are working with a third-party expert to conduct our own testing at our sites that were identified by the media. We will not have the results of our testings for several weeks. When we have the results of our testing, we will work closely with our industry and others to address any concerns and issues. And now with regards to the costs of all of this, so the potential cost of removal of LED sheet cables in their network, given where we are in the process, it is far too soon to make any projections on what the potential financial impact might be to the company. There are numbers of unknowns in this area, including whether there is health risk presented by undistributed LED sheet cable, and if there is a risk, how that risk should be addressed. As a result, we do not believe there is a meaningful way to estimate any potential cost to the company or that any such estimates would even be useful. Of course, at the moment, we'll get to know more when those results get back. And even after those results get back, I highly doubt that Verizon will have to pay a lot of money to address this issue because, well, it's something that has happened a long time ago. And probably they're not the only company that have these types of cables. So if they are doing it, probably this is going to lead to other companies doing the same thing, maybe even government getting involved, etc., etc. Now, with regards to the company's financials, this earnings report, I'll go to the infographic because all the valuable information is there. So here we have it. Total consolidated revenue declined 3.5% year over year, reached $32.6 billion, adjusted EBITDA of $12 billion, that's a growth of 0.8%, and adjusted EPS $1.21, a decline of 7.6%. But if you compare 2022, well, the first half of 2022 to the first half of 2023, you can see that cash flow from operation has increased to $18 billion. CapEx stayed the same a bit. Free cash flow increased to $8 billion, and then dividend paid increased by $0.1 billion. So as you can see, free cash flow $8 billion, dividend paid $5.5 billion. So the dividend at this point is pretty safe. Now, more on the dividend aspects, and it was asked during the earnings call whether or not they are going to use that extra cash for buybacks. So first they say here that they are on track to deliver 200 million to 300 million of savings this year from the transformation effort, and they continue to make progress towards achieving their goal of $2 to $3 billion of annual cost savings by 2025. They continue by saying, while we do not normally guideline for free cash flow, our strong results give us a clear line of sight to more than $17 billion of free cash flow for the full year. Now, net unsecured debt at the end of this quarter was $126 billion, an improvement of $3.2 billion compared to the end of the previous quarter, and $4.1 billion lower year over year. They ended the quarter with $4.8 billion of cash on hand. And so, to answer the question about buybacks, they said the capital allocation priorities are unchanged. We said first we would invest in the business. The second priority is our commitment to the dividend and the growing dividend, they say. Our third priority is to delever, and you'll see us be focused on that. And then once we get to the leverage metric of 2.25, we will consider buybacks at that time. My opinion, won't really happen that soon. But I think most investors should be happy with their priorities right now. Invest in the business, still deliver on the promises of growing dividends, deleverage of the business, and then if there is more cash available, go and maybe buy back your own shares. Now, if you enjoyed this type of video so far, leave it a thumbs up, subscribe if you have not, I would really appreciate that. It's free, so why not? I'm covering a lot of companies during this earnings season on this channel. So if you don't want to miss out, hit that subscribe button and maybe the notification bell as well. And if you want to support me even further, do check out the link down in the description and in the pinned comment to get the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much for all the support. So continuing here, revenue summary. Wireless service grew 3.8% year over year to $19.1 billion. Total consumers declined 4.1% to $24.6 billion. Total business declined 1.9% to $7.5 billion. Now, if you look at the operating metrics, again, you might say, for example, the 8,000 here wireless postpaid phone net addition is not much, but it's much better. Well, it's better than before. It's 8,000 this time. Wireless retail connections, 143.2 million. Broadband net addition, 418,000. And this includes 384,000 fixed wireless access net additions. Fios Internet net additions, 54,000. If you look at the churn, 1.07%. And if you look at the wireless retail postpaid churn, under 1%, yet again 0.83. So overall, while this might not be a blowout quarter, things are getting better for the business. They are still growing, well, not like a growth company, but they are growing. Their investment in 5G is paying off, while the underlying business, the profitability of the business becomes better, growing cash flows, deleveraging of the business. So everything that investors would like to see is happening right now. And of course, the biggest fear here is the dividend safe? Yes, as we've seen, I think the dividend is pretty safe right now. So looking at the graph, we can see that not much has changed these past 2 weeks. Of course, we had good earnings. The stock tried to go over the 20-day moving average, got a little rejection there. Of course, on Wednesday, Fed meeting, volatile market is to be expected. But I do think that around $34, $33 or so, the risk here is much smaller than the reward currently. And if you look at the average price target from the analysts, they are all seeing, well, on average, a 25% upside from the price we're at today. So hey, we'll take that. So that will be it for this video. Of course, do share your thoughts down in the comments below. I'll make sure to cover AT&T next after the earnings call. So if you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, and I'll see you all in the next one. Bye-bye.